Tomorrow is May 1st. A couple days ago, I released a video about how Wall Street got sell in May wrong. And it shows that sell in May really just works in midterm election years based on the last 100 years data. In this video, I want to show what are the most vulnerable stocks starting May 1st in S&P 500. Let's quickly just do a recap right here. I am showing you the broader markets, S&P 500. We're looking at May 1st until June 24th for a 55-day period since 1962, midterm election years, which means each of the bars are 4 years apart. As you can see, the trend chart shows the statistical down cycle. This is showing you that seasonally this is going to be, has moved down in the past. And as you can see, there are 5 up years, but there are many more down years. Basically 69% of the years have been down historically. So chances for it to repeat this year is pretty higher than it going up. And the years that it's gone up for this 55-day period, look at that. In 2018, it went up 2.35% after dropping 2.27%. Sounds like low volatility. It closed up 3.52% in 2014, dropped only 1.27%. That was pretty stable and bullish. In 1990 and 86 were a little bit higher. However, the rest of the years are negative. So this is something I covered in the Sell in May video. But now I want to look at the stocks. I'm looking at S&P 500. I am the analytics engine for May is now showing a list of all of the patterns it's detected. I have checkbox PE plus 2, which means only return me patterns based on the midterm election years. Based on the last 10 midterm election years is selected here, and at least 9 of those 10 years should be profitable, whether it's bullish or bearish, short or long. Opportunity table then shows you the list of patterns that were detected, and they are sorted by Sharpe ratio. If you don't know what Sharpe ratio is a measure of risk. Higher Sharpe ratio means that your returns have been more consistent. Low Sharpe ratio means that your return from period to period were less consistent. So, but what is so interesting about this list is that the top 10 opportunities that are listed, 9 out of 10 of them are short. The very first one is Caterpillar. Caterpillar, for a 58-day period that I have selected, it was historically 9 out of 10 years it went down. And the green columns are the AI scoring columns. It shows you the calibrated probability. It says that it has 75% chance of repeating it for 2026. Next one, Valero Energy Corporation. Also short, 82 days from tomorrow, May 1st, until July 21st. Lennar, Skyworks. This is the only bullish opportunity that I found. However, it has fairly low Sharpe ratio. It's below 1. It's still not too bad, but it's been okay, but it's long. It is showing that this is a long opportunity from today for the next 11 days. And then continue with shorts. What's so fascinating, if you look on the bottom, it had found all of the opportunities, 29 opportunities that fit the criteria, and 13 of them were long, but 16 were short, and out of the first 10, 9 of them were short. that tells you that historically this is a very weak period for the stock market and S&P 500, at least those stocks. So I would say chances are definitely about 66%, 66 to 69% that this is going to repeat this year. Even if it closes up, I think it's going to at least correct first over the summer. And when you look at fundamentals and geopolitics, you can actually kind of feel it that history might repeat itself and show a correction here. So when is this going to end? Well, this is going to end by end of the summer, or at least the probability wise. And then the biggest pattern, which is a bullish pattern, is going to start. I call that the 100-year pattern. I wrote a book, and the title of the book is the 100-year pattern, since it was never documented until this book was released. Here's the pattern. It starts on September 27th of midterm election years. It lasts 295 days until July 18th of the following year. It went down in 1930, and it has never gone down since. So nearly 100 years of bullish pattern. This was never documented before, but now you know this is when you want to be in the market. As long as the market repeats itself, it's going to be a bullish time for the market. Anyway, these are all based on data. So if you like information about data-driven selections and application of AI in finance, definitely subscribe to this channel. It's going to be very informative. I release videos like this fairly often, and they're all data-driven and based on insight. And please like and subscribe so you don't miss the next video. Until next time.